I forgot we were doing the banks. So here's Procter Gamble for you, another stomach-churningly exciting company. They reported results this week, and actually, for a company that's very, very steady, these results weren't that good. Stock was down about 2% on the news. The market thinks these results aren't that bad, but let's have a look, see what you think. So, look, if you haven't heard of Procter & Gamble, and I guess I can give you a small pass. They're one of those sort of consumer giants with tendrils in everything. So they'll own brands that you will know, like Pampers and like Ariel and Gillette and Head & Shoulders and Olay and Old Spice and those things that the kids thought was a tasty treat during COVID, Tide Pods, as well as hundreds of other brands that you'll have seen when you're doing your weekly shop. It's one of those dividend, what do you call it, Steve, when you've got 66 consecutive years of dividend increases? Is that a king?
66 would be a king, 50 for a king, 25 for an aristocrat, 10 for a contender or something, and 5 for a Briscoe's portfolio.
So, as you can tell, it's been a fairly solid, reliable business for people who invest for income. So the headlines on this report was pretty much slight misses across the board. P&G has pretty much been trying to sort of pass on inflation-led increases to its consumers, and on the face of these results look to have been somewhat unsuccessful, which is strange for a business like Procter & Gamble, because this is what Procter & Gamble is supposed to be able to do. So here's some of the figures. It was a 0.2% miss on revenue. This was due to weak sales on the beauty and the grooming sections of the business. The grooming section, which missed by as much as 6.6% on their guidance. Healthcare, fabric and baby all came in better than expected by around 1%. They missed on op margin guidance, falling 72 basis points to a still healthy-looking 20% operating margin. Organic growth across the board was a total miss in all categories except the fabric section. Grooming actually managed zero growth whatsoever. So I think this is potentially worrying. We know inflation has been as much as 8 or 10%. So to see growth coming in at half of that is a little bit worrying. I think it's masking that a small section of Procter & Gamble's customer base seem to be trying something else or shopping down. So I don't think it's a huge issue. I think this is, it's going to be a rising price, this cost of living. This means that some people just won't be able to afford Procter & Gamble brands because they tend to be mid-range brands. The worrying thing for me was that they're guiding for revenue to stay flat, Steve, 0%. And they're even saying that it could decline by up to 1%. And they think that EPS will be between 1% up and 4% up, Steve. That doesn't leave an awful lot for a dividend increase.
It doesn't leave an awful lot for a dividend increase. And you are, to my mind, right in thinking it's the point of these kind of defensive stocks that they're meant to offer you some sort of inflation protection. What is the point of having a bunch of brands if it doesn't allow you to raise your prices to consumers without them all running away? And either they haven't raised their prices to consumers, or they have raised them and most of them have run away, or a lot of them, have run away, leaving them basically back where they started again. So a 0.2% miss, I kind of call that a meet, I guess. I'm not really sure where I think meeting is kind of, I suppose strictly it is a miss, but I'm not too worried about a 0.2% miss. But my thought is, yeah, I mean, if you think inflation is going to be close to even 2% or something along those lines, why you would be interested in buying a company 20-something times earnings, P&G? Yeah. These stocks do tend to hold up fairly well. I was looking at Unilever the other day, which is in a similar spirit but in some slightly different categories, and looking at that and thinking to myself, well, this has actually held up quite well, and where it once looked kind of attractive when everything else was at a PE ratio of 30, it looks quite unattractive now because it's roughly the same proposition and other stuff is doing worse. On the point about shopping down from P&G, I thought P&G might be the kind of thing that people would shop down to. I know that Pampers is not supposed to be. It is a well-known, well-respected, well-trusted name. I have some of their products back there. I don't wear them personally, but I tend to put them on the baby. But I thought they might be the kind of thing where people who were coming out of a nice big liquidity effort might have been buying kind of higher end stuff. So nappies that are made out of bamboo and other such stuff that we don't use because we use reusables and they're the worst thing ever. But that people might kind of fallen back onto buying kind of the ordinary Pampers stuff, which the price isn't super premium on these things. But that doesn't seem to have happened either. So I'm kind of slightly surprised by that. And I also thought they were exposed to pretty good categories, unlike Unilever, which is exposed to food, which has shown no growth at all. I thought kind of personal products and the like were meant to be a bit more encouraging from P&G.
Yeah, and same here. I think that's, like you said, it's the whole point of Procter & Gamble is that you're paying 25 times earnings because you've got a company here that will exponentially increase its sales by at least the rate of inflation, which will in turn spit out a 2.5% dividend or whatever it is at the moment. So I think it's I've long said it was a fairly expensive company. I think I've said that before in one of my I just don't understand why it's here. I think revenue growth of 0 and EPS growth of 3 or 4 or even less than that is not enough to maintain the 25 PE ratio. But it also makes a mockery of DCF calculations, which is something we've long laughed at, is that, somebody would put a 12 exit on something like Procter & Gamble and it very, very rarely trades down as low as that. So it just makes it very, very difficult to value. This is one of those stocks, I think, that you've got to buy in the mindset that you're buying it for the dividend, and you're not going to realise the capital appreciation or depreciation of your money, and you're just there to receive those 4 quarterly payments, which you would assume Procter & Gamble will be able to make for the rest of its lifetime.
I think so. I wouldn't expect demand to fall for their products ever particularly. I mean, even in a recession, to be honest, I think they are reasonably well kind of placed here. The way these companies, as I understand them, try to achieve growth isn't usually by pushing volumes, because it's not about, in the case of Pampers, I'm not going to buy more nappies than I can use. The kid goes through them at the rate he goes through them at. I'm not going to start putting them on faster or anything like that. But they tend to do it, I think, by trying to shift their portfolio and buy new products and sell other products and try and get themselves exposed to whatever they consider to be important growth vectors. I thought quite highly of P&G on this. But maybe I'm kind of wrong in that regard. I mean, maybe the idea of something you'd hope for slightly better than 3% revenue growth, given that we're supposed to be trying to fend off inflation here.
Yeah, well, this is the thing with Procter & Gamble, is you get a new word introduced to your vocabulary, which is shrinkflation. I don't know if you've ever come across that.
I have come across shrinkflation, yes. And this I always thought it was a thing about my imagination, by the way. I just thought I'd got bigger.
And this is why, things like Pampers, which you maybe used to have 10 in a pack, all of a sudden have 9. And that's kind of the way that Procter & Gamble make more money, or make more earnings, at least, is that they start to cut what's in the packet. And you'll know this if you ever bought a wagon wheel when you were a young lad. They used to actually be big. They were called a wagon wheel because they were about the size of a wagon's wheel at one point, and now they're barely the size of like a Tonka car or a Hot Wheel wheel. But it was very interesting to see that. The other thing to note is that it's not a particularly worrying sign to see people trade down, because when people trade down, they often get a poor brand experience because products are cheaper for a reason. They tend to not have even though some benefits that you'll get from a branded product are perceived and not real, people can believe them into reality. So you'll find that when economic conditions lighten somewhat, you'll find that people trade back up to P&G. From what I'm thinking is from P&G down to maybe supermarkets' own brands, and I would expect them maybe to pop back up into P&G brands going forward. So I don't think this is a huge issue going forward. I am worried that they're looking to decline revenue. You would hope that they're going to do something about that. But yeah, I think it's very, very expensive business. I mean, I certainly wouldn't be buying it. Is it even on your watch list, Steve?
No, not really. I'm familiar with shrinkflation because I do own Kraft Heinz, who basically have said in recent quarters that they are indeed going in for shrinkflation. Their idea is that people like being able to buy a thing of ketchup for a £1.50 or whatever it is, and they don't really care whether the amount they get is the same or slightly smaller. But what they don't want to do is come in and find them having to pay more at the till for the thing. And that's, I think it's quite a smart move. It reminds me a little bit of something that my wife showed me on either Instagram or Twitter or some other horrific social media thing that I didn't see for myself because I don't look at them very much. But it was when fuel prices were going up, and someone said, I don't know why it's such a problem that fuel prices are going up. Just put 20 quid's worth in. There you are. And it'll cost the same thing. I mean, that's basically shrinkflation in action from what I can see of it. You just get less for your 20 quid. You spend the same amount but get less stuff. And that's it's a reasonable way of protecting people from finding their supermarket bills are too high. It just means that they get less stuff for it, though.
Yeah, and that's it, isn't it? And I think it's a very good strategy for these kind of companies because they've got to such a scale that it's very difficult for them to make more money, especially when, they can't go out and throw money at new brands because, they're going to fall under the commissions that regulate this. So one of the ways that you can do it is by a little bit of shrinkflation, and obviously by trying to get a 2% increase through, or maybe a 1.5% increase through some of the inflation costs through. It's a really, really sensible and well-used strategy across the sort of 7 big companies that run everything we buy in the supermarket. So, interesting one for me. I'd like to answer my own question earlier. I just couldn't buy it.
No, I don't think I could at the moment either. But they're going to be okay, though. I mean, neither of us thinks they're in any imminent danger.